It's incredible how fast the script can flip for financial markets. One minute, the whole story is about growth and innovation, and the next, it's all about survival. Today, we're going to break down exactly how that shift happened by looking at a dramatic series of events in early 2026 that took the world from talking peace to hearing war drums. And boom, it all came to a head with this one single line. On April 1st, 2026, the source material describes President Trump giving this televised address with a very clear ultimatum for Iran, promising a huge military escalation. For investors, this was the moment. The floor just completely fell out from under them. And the market's reaction? Oh, it was immediate. And it was brutal. The S&P 500 just plunged, hitting its lowest point in 7 months. It basically wiped out an entire quarter's worth of gains in the blink of an eye. The message from Wall Street couldn't be clearer. The risk of a much bigger war was now being priced into everything. So what was really behind all this panic? Well, it was a hard deadline. The president gave Iran until April 6th to do two things: agree to a new nuclear deal and, maybe even more importantly, reopen a vital global shipping lane that had been shut down. But here's the wild part. What makes this story so incredible is where things stood just a few weeks before all this. The market wasn't worried about war at all. In fact, it was betting on peace. So how on earth did we get from diplomatic optimism to the brink of war so incredibly fast? Just look at this timeline. It shows you how insanely fast everything completely unraveled. February 25th, you have reports of a positive outlook on the nuclear talks. Then, just a week or two later, in early March, military operations are already underway. By March 30th, the market hits rock bottom, and only 2 days after that, you get the president's public threat. The speed here is just astonishing. This right here, this really captures the mood back in late February. The chance of a real diplomatic breakthrough felt so possible that investors were actually selling off shares in big defense companies. The market was literally putting its money on peace as the most likely outcome. And this just shows the complete 180-degree turn in what the market was focused on. In February, the big story was about an oil surplus, right? Prices were down in the low 70s. By March, that story was just gone. It was replaced by what analysts started calling geopolitical survivalism. All of a sudden, the risk of supply being cut off sent oil prices through the roof. So, what was the actual spark, the trigger for this massive shift? It all centers on one tiny strip of water, a geographic choke point that has a huge outsized impact on the entire global energy market. We're talking about the Strait of Hormuz. It's basically the main highway for most of the Persian Gulf's energy exports. So when Iran threatened and then actually acted to stop ships from passing through, it wasn't just some regional problem. It was a direct threat to the entire world's energy supply. And the numbers here are just staggering. Think about it, roughly 30% of all seaborne crude oil and another 30% of all liquefied natural gas passes through this one single point every single day. If you shut that down, you create an immediate, physical traffic jam in the global system. And the result? Well, it was predictable, and it was painful. The price of Brent crude oil shot up to over $115 a barrel. That's a level nobody had seen in more than 3 years. This wasn't just traders guessing. It was the market reacting to a very real, very tangible supply shock. Now, a shock like this didn't sink all boats equally. Not at all. Instead, it basically tore the market in two, creating this really sharp divide between the sectors that actually benefit from conflict and the ones that get absolutely crushed by it. Analysts actually have a name for this. They call it a bifurcated market. It's where the main index, like the S&P 500, might be down overall, but under the surface, you've got these wild swings in both directions, all being driven by one single event. So let's break it down. Who ended up on which side of this great divide? Well, the winners were pretty obvious. Defense contractors like Lockheed Martin and RTX, and of course, energy giants like ExxonMobil and Chevron. And the losers? Tech companies like Apple and Nvidia took a hit, and so did travel stocks like Delta and American Airlines, who suddenly faced skyrocketing fuel costs and, well, nervous customers. And you gotta realize, this wasn't just some short-term blip. If you look at this chart, you can see the performance of these big defense stocks over the 3 years leading up to the conflict. The surge is massive. RTX more than doubled. It suggests the market was already pricing in a more dangerous world long before the first shots were even fired. This shift was so profound, it completely changed the entire story of the market. You see, the big story of 2025 was the AI supercycle, right? All about technology and efficiency. But by March 2026, that was totally pushed aside by a much older, much more primal story: geopolitical survival. So when you put all these pieces together, it really points to a much bigger picture: the emergence of what you could call a new war economy, where global priorities and, how people invest have been fundamentally rewritten. One analyst really nailed it, saying the Goldilocks environment of the year before, that perfect mix of low inflation and booming tech growth, was officially over. This geopolitical shock was, at its core, a massive inflationary event. And look, these weren't just abstract threats. According to the source, Operation Epic Fury involved a stunning array of advanced weapons. We're talking long-range Tomahawk missiles, next-gen stealth fighters like the F-35 and F-22, sophisticated missile defense systems, and even deep-penetration B-2 stealth bombers. And here's the bottom line: every single one of those weapon systems translates directly into revenue for specific companies. RTX makes the Tomahawks and the Patriots. Lockheed Martin builds the F-35s and the THAAD systems. Northrop Grumman produces the B-2 bombers. And all the while, the energy giants are just raking in profits from those sustained high oil prices. Now, here's a really fascinating twist. In a crisis, you'd think everyone would rush into gold, the traditional safe haven, right? Well, at one point, gold actually sold off because investors were just desperate for cash. Instead, the ultimate safe place for global money became the US dollar, which surged to its highest level in years as capital flooded into American assets. This entire episode really signals a shift towards something some people are calling kinetic diplomacy. It's basically a policy where direct military action and open threats, like targeting another country's power grid, start to replace the slower, more traditional process of negotiation. And now, the markets are being forced to price in this new aggressive reality. And that leaves us with a final and pretty crucial question. For decades, markets were driven by narratives about innovation, globalization, and making things more efficient. But when the primary driver becomes conflict,